Okay, hello everyone. We continue in our video now with the different types of funds in financial markets. We have discussed different financial institutions in our previous video. Now we will continue from the different types of funds that is covered in the second chapter of our reference textbook. So first of all, an important type of fund is the pension funds. So these are actually retirement plans funded by corporations or government agencies for their workers. And basically, these are administered by the trust departments of commercial banks or life insurance companies. Typically, if you are, for example, working in a company, you are saving some portion of your salary for the pension. And the corporation, or you might also work in the government, or the government, contributes some part of similar savings, added by the corporation or the government on top of your own savings for the pension. Altogether, this saving is collected from all the employees and pooled together for investment. And it is managed professionally by commercial banks or life insurance companies, etc. So this is a very big portion of funds within the total asset size. Another type of fund is the so-called mutual funds. And basically these are under corporations that can accept money from investors, savers, and then they use these funds to buy various assets such as stocks, bonds, or other short-term debt instruments such as corporate bonds or government treasury bonds, etc. Again, mutual funds are quite important for the economies, and they also offer economies of scale because individuals, they don't have the resources or time to select which asset or asset class will perform better in the near future. But mutual funds, they have once they pool all these investments together, they can utilize economies of scale, meaning that once the amount of investable money is larger, then they will have enough resources, and human capital to to allocate professional managers to manage your money once you invest in the mutual fund. Basically, that's going to be managed professionally, and these funds will have the resources to conduct research about different markets, etc. So that's in the benefit of the investors, at least theoretically. Another type of fund is exchange-traded funds. These are also quite popular, and they are really giving you various investment alternatives. So these are similar to regular mutual funds and are operated by mutual fund companies most of the time. The nice thing about these exchange-traded funds, basically, it's just like a new stock actually in the market, in the sense that it gives you the opportunity, for example, to invest in the whole index. Okay, as an individual investor, replicating the whole, let's say, S&P 500 index wouldn't be easy for us. It would be, costly and inefficient for individual investors to try to replicate the whole index. But instead, they can invest in ETF, S&P 500 ETF, that will basically imitate this index by investing in various underlying stocks in the S&P 500 index. And therefore, with easy access, we can expose ourselves to the S&P 500 index as an investor. Alternatively, for example, you might want to invest in the Chinese stock market, and there are also ETFs available for foreign stock markets as well, and that will really save your time and reduce the cost instead of trying to access in the Chinese market. The ETF can do all these, they can manage these steps much more efficiently, and that will cost you less to invest in the ETF comparing with the direct trying to access to the Chinese market directly. In some cases, actually, this might be impossible as well. For example, China has its own special rules about portfolio flows, capital flows, and only qualified institutional investors are allowed to invest in the Chinese market with some certain limits. So actually, as an individual investor, we can not even access and take exposure in the Chinese companies directly, and therefore all these difficulties would be overcome by investing in the different ETFs. And that's really a very huge market, ETF funds. Also for various commodities, there are ETFs that are specially designed for various commodities. For example, the gold ETFs are another popular type of ETF. And instead of purchasing the physical gold and trying to store in your, let's say, apartment, you can invest in the gold ETF that will basically go one by one with the gold prices. Okay, that's going to be again reducing your cost because you don't need to keep the physical gold directly. That preserving large amounts of commodities is also not easy for many investors. So considering all these factors, ETFs are really very important, and they allow the investors to really diversify their portfolios. As we just mentioned, you can invest in various commodity ETFs, gold, as an insurance type of investment if there is, let's say, geopolitical risks or there are some serious financial crash or some governmental failures, etc., political risks. Gold can be a good diversifier in your portfolio, or alternatively, you might invest in abroad, ETFs in other developing economies as well. So all these opportunities are provided by the ETF funds. We can say a few things also about the hedge funds. These are similar to mutual funds actually, but because they accept money from savers and use the funds to buy various securities, they are similar as the mutual funds, but there are some important differences as well. Also, we should note that there are regulations that govern mutual funds and hedge funds in different countries. So there might be some small, generally small differences between different markets. But essentially, when we talk about the hedge funds, they are less regulated compared to the mutual funds. And depending on, as I said, the different financial markets, the extent of these differences might change. But it is okay in general to say that hedge funds are much less regulated compared to the mutual funds. And the difference in regulation stems from the fact that mutual funds typically target small investors, whereas hedge funds typically have some minimum investment amounts. They have some minimum entry requirements. So you need to have a bigger amount in order to be able to invest in a hedge fund. And therefore, hedge funds will, it is difficult, they have more restrictions for the investors to get in, and also they will require, more, as a result of more wealthy individuals investing in these funds, they have more flexibility. They have more flexibility in terms of their investment strategies, and their regulations are much less, as we mentioned. That's because presumably wealthier individuals are investing in hedge funds, and therefore they are willing to take this risk, and they understand the risks involved in hedge fund investments. But mutual funds usually they have they are basically managing the funds from the public, large populations of people in the country. So there will be more restrictions also in terms of their strategies that they, or the types of assets they can invest in. Here is a table that shows us basically the funds and assets under management by these different funds in billions of US dollars. So we can see that, for example, the Bridgewater Associates. This is the founder of Bridgewater is Ray Dalio. He's a very well-known, famous founder for the Bridgewater Associates, which is a hedge fund. And then there are other funds. Some of them you might also know very well, such as like BlackRock is very famous. Of course, you might know JP Morgan Asset Management, and then there are many others. So these are some examples as of 2013. As of 2013, of course, if we check this now, there might be some significant changes in the ranking of these funds that displays the assets under management. But basically, these are all very major, large funds that basically still operate. And we can see these panels, and in these panels it is shown that there are US bank holding companies, there are world banking companies, and leading global underwriters. So as we discussed, the underwriter basically here implies the investment banks that help corporations to raise capital, right? That's what we mentioned before. For example, JP Morgan, Deutsche Bank, Citi, Barclays, Merrill Lynch, Morgan Stanley, Goldman Sachs, Credit Suisse, UBS, HSBC. So these are leading global underwriters. They have all these investment banking branches actually, and they can help corporations to raise capital by issuing bonds or by issuing the shares. And then there are, as you see, world banking companies. For example, Deutsche Bank, as you know, from Germany, BNP Paribas from France. For example, Industrial and Commercial Bank of China. Actually, this is also very huge corporation. By the way, Chinese banks are also among the top largest corporations in the world. I mean, they are of course publicly financed. I mean, they are basically public banks. They belong to the government or state, at least with their majority shares. And there are, of course, strict regulations in China as well. So most of the banking industry in China is it is heavily government or public owned, including also the state shares of the different municipalities and states. So their banking and other major industries are heavily government owned or government related institutes own these corporations. So these are again some examples only. And then in US bank holding companies, as you see, again, these are well-known banks, such as JP Morgan Chase, Bank of America, Wells Fargo, etc. Now let's come towards the stock market. Stock markets, again, are very important within the financial markets. In the US, there are a number of different stock markets. Two leaders are NYSE Euronext and Nasdaq. So basically, NYSE Euronext was formed through the 2007 merger of the New York Stock Exchange and Euronext. Actually, this is a very important merger that occurred in 2007. And this is at that time the largest European exchange, Euronext. So in different countries, there are different number of stock markets. There are different exchanges that specialize in different asset classes as well. But when we talk about the stock markets, in our Turkish economy, we have only the Borsa Istanbul. So we have a single stock exchange. But in in some developed countries or in developing countries, for example, in China, they also have two different stock exchanges. One of them is in Shanghai, the other one is in Shenzhen. So these are the two stock exchanges in China, just like the US. They have in the US they have Nasdaq and New York Stock Exchange, NYSE, and they have some differences between these stock exchanges as well. For example, in the Chinese market, let's say something about the Chinese market. The Shanghai Stock Exchange is more heavier in terms of larger corporations, but the Shenzhen Stock Exchange, which is more oriented towards small and medium corporations. I mean, they also have, of course, some very large corporations, but mostly speaking, it's they have also some recently established technology stocks. So the technology orientation is a bit more emphasized in the Shenzhen Stock Exchange compared to Shanghai Stock Exchange. Okay, there's difference, and some similar difference exists also in the US market. Nasdaq, you can find more small and medium corporations. They have more weight in the overall market capitalization, but New York Stock Exchange has bigger corporations that are listed as well. So that's the general difference, and we can have similarly different exchanges actually, not only for stocks, but some exchanges specialize in, for example, commodities, or some exchanges specialize in futures and options, like Chicago in the US. Their exchange is specialized in options trading. There is also a futures exchange, again based in Chicago. Similarly, in Chinese market, you can find actually three different commodity exchanges. Shanghai, there is Zhengzhou, and there is, I think, Dalian. Dalian is also another commodity exchange. So there are different locations that set up different exchanges. The main idea is traditionally or historically, when they set up an exchange, there are a few considerations. For example, of course, the first thing to consider, if there is a stock exchange, usually it is set up in the economic center, the financial center of that country. For example, in Turkish market, Istanbul has the stock exchange because Istanbul has the biggest, share in the economic activity of Turkish Republic. So that has the priority. People set up the exchange in Istanbul first. Similarly, New York or London and Shanghai in China. Beijing is the capital, but Shanghai is the financial center. So the stock exchanges are concentrated there. And for other financial products, again, there might be some different exchanges set up. That's also each exchange will have its own specialization, because at the end of the day, they need to have professionals that can regulate the market. They can monitor what's going on in a specific type of asset class. Therefore, to promote this specialization between different exchanges was the reason why we have these different exchanges in different locations, etc. So basically, there are two types of market procedures: physical location exchanges, which include the New York Stock Exchange and several regional stock exchanges. And then there is the electronic dealer-based markets, which include the Nasdaq, the less formal over-the-counter market, and the recently developed electronic communications networks. So these are the main categories, let's say. And of course, over-the-counter market we should also emphasize, because over-the-counter market has been important for also corporations, and through the over-the-counter market, usually corporations hedge their positions. For example, their FX risk, or their, if they want to get in a forward contract in a commodity or foreign currency, they can utilize the over-the-counter market. That's also, again, usually advantages for them, because they might want some custom designed financial product that is special for this corporation. And that can be done in the over-the-counter market. And when we say over-the-counter market, actually we are referring to this electronic dealer-based markets. So there is no physical location where you go to the over-the-counter OTC. I mean, this over-the-counter market, we call that as OTC in short. So it doesn't have a specific location. Okay, it's basically based on various investment banks, for example, that offer the quotations for that product. As some definition is given here, the OTC market, this is a collection of brokers and dealers that are connected to each other essentially by electronically by internet these days. And this that provides for trading in unlisted securities. There is also dealer markets. This includes all facilities that are needed to conduct security transactions not conducted on the physical location exchanges. We need to introduce also these concepts of going public and the IPO. Basically, the act of selling stock to the public at large by a closely held corporation or its principal stockholders. So this is the definition of what we mean by going public. And similarly, initial public offering, we call this as the IPO. The market for stocks of companies that are in the process of going public. So that's the IPO procedure. But we will discuss much more details about the IPO procedure in the coming weeks. Here we can see the S&P 500 index total returns. That's dividend yield plus capital gain or loss from 1986 to 2011. So as we see, the S&P 500 index actually performed most of the years quite fine, quite well. I mean, as you see, from 1968, starting from here, all the way to this 2012, as the last date of observation. So there are some, serious drawdowns in the market, of course. For example, here, around this 2000, the year 2001, 2002, etc. And then, of course, this 2008 financial crisis hit the S&P 500 index very seriously. As we can see, there is a very significant drawdown in the market, as almost close to 40% down from its peak in this year. I mean, in the overall 2008, basically the return is close to minus 40%. So it's a serious drawdown of the market compared to the previous years. But most of the time, during regular or good times, let's say, the annual returns of the S&P 500 index is really good. And notice that this dividend yield is also included in these return calculations. So most of the time, the performance is fine. It's quite good, actually, for the S&P 500 index. As you see, if we open actually, some financial website, such as Yahoo Finance, for example, we will see this type of tables. And whenever we open, let's say, Yahoo Finance, we need to enter the ID or the name of the corporation that we are looking for the stock price. Like here, if you want to find the Facebook stock prices, then you need to enter its ticker ID that describes the Facebook stock. And then it shows us a variety of information, like it shows us the evolution of the prices in different time scales, like 1 day here, or 5 days, 1 month, and up to 1 year. So we can customize the chart that you want to display for the close prices of Facebook Corporation, and also some additional information such as open price, the previous close days range. As you see, this 52-week range. 52-week range is like the last 1 year minimum and maximum values that are observed in the Facebook prices. There are also other information like market capitalization, the price earnings ratio. By the way, we will later on talk about these ratios one by one. Okay, we will see what we mean by the market beta or the price earnings ratio, EPS, earnings per share. Okay, so all these, we will get more details later on in the coming chapters, but essentially this is what we display in a typical, chart for the stock market and various stocks that you choose. Okay, next we will talk about the stock market efficiency. Basically, this concept is again very important in financial markets because we want the financial market to conduct the price discovery role properly. The market should price assets with their appropriate values, and any undervaluation or overvaluation is not something we want in the financial markets. So it should reflect all the information. I mean, the price of a stock or another asset should reflect all the information that is available about this company and stock. Okay, and that's the best way actually the stock market performs. I mean, if transparency and regulations are well defined, then the price discovery role of the market will perform very well, and that's what we want. I mean, and this is also desired by the regulators of the market as well. Okay, the market price is actually the current price of a stock. For example, you open Yahoo Finance for Facebook, and you will immediately see what's the last traded price for Facebook. Okay, so that's going to be the market price. That's the current price of a stock, which is based on the current transactions. Next, we will talk about intrinsic value, and this is the price at which the stock would sell if all investors had all knowable information about the stock. We already mentioned the intrinsic value in the previous chapter. Basically, the intrinsic value, we mentioned that it's based on the expected future cash flow and its risk. So we can consider the intrinsic value as the true price of a stock, okay? And the intrinsic value changes over time as the company succeeds or fails with new projects, competitors enter or exit the market, and so forth. We can guess the intrinsic value, but the only problem is that whether your guess, is better than the existing market price is another question. That's something that you need to test empirically in order to answer whether you can actually outperform the market. And there is the concept of equilibrium price. Basically, equilibrium price means the demand and supply meets each other. Okay, that's the price where demand equals to supply. Okay, this the equilibrium concept applies to all kinds of assets and also goods and services. We can extend this idea. So basically, in an efficient market, we say it's a market in which prices are close to intrinsic values and stocks seem to be in equilibrium. So we need to have the equilibrium, and in that equilibrium, intrinsic value is basically equal to the market price. So there is also the very important field under the finance theory, that's the behavioral finance, and there has been a lot of research around this under this area. So the efficient market hypothesis, this is actually quite fundamental in the modern finance theory, and it implies that on average asset prices are about equal to their intrinsic values, uh, and the logic behind the efficient market hypothesis is straightforward. So basically, if a stock price is too low, rational traders will quickly take advantage of this opportunity and they will buy the stock. And once they start to buy, they will push the prices up to the appropriate level. Likewise, if the prices are too high, rational traders will sell the stock, pushing the price down to its equilibrium level. And proponents of the efficient market hypothesis argue that these forces keep prices from being systematically wrong. So, what about the market efficiency? So basically, if the market is efficient, then we should not need to create trading strategies in the hope of outperforming the market. So that would be a waste of time for most people to seek bargains by analyzing the past data on stocks. So by looking to the past information, in an efficient market, we cannot create extra value by analyzing the past, because the current price already includes all that information. That's the assumption, remember? So this is what is implied by the market efficiency. That follows because if stock prices are already reflect all the publicly available information, they will be fairly priced. And a person can beat the market only a few times by luck, or you might have some insider information. So insider information, insider trading, that's a different concept. Okay, that. But in an efficient market, basically we cannot outperform the market return or market index consistently year by year. So last slide in this chapter, you should think about a few different questions I put forward here. These are all important and you should think about these a little bit, and you can take some small notes once you have an answer. For example, what does it mean for a market to be efficient? We should really understand this and be able to write a few things about this concept. And then, is the market for all stocks equally efficient? You should explain. So there are also certain differences between different stocks, because remember, first of all, some stocks might not be very liquid in the stock market, but some stocks, they are very highly traded, they are very liquid. Always there are buyers and sellers for both for the same stock. But in some cases, the liquidity is very low, and there are maybe few transactions on that stock. And why is it good for the economy that markets be efficient? Think about this. What's the importance? Why should I care whether the market is efficient or not? Remember, it's important the market has this efficiency property, because the market will be actually the place where the public actually takes part or benefits from the growth of the economy. I mean, the whole idea about stock markets is we invest in the stock market. The prices should be, reflecting all the information. So if there is some bad news about the company, we want it to be perfectly reflected in the market price. Or if there is some good developments about the economy, again, we expect all this should be priced in our shares that we are holding. So it's always good to have the market efficiency. Another thing you need to think about is what's behavioral finance. What are the implications of behavioral finance for market efficiency? So we should also think about the behavioral finance aspect. Okay, so that's all for our video